Good morning. This is James with 77 Financial Group. You're listening to 15 Minutes of Finance, where in the next 15 minutes, I bet I can get you excited about investing. Let's do it. All right. Happy Tuesday, everybody. We are here up and at 'em early in the morning like we used to be early in the OG stages of this podcast 3 years ago. I remember getting up at 4 a.m. to just get prepared for this. And it's come such a long way from my parents' basement to an office in downtown Carlsbad. So very, very far. We've come very far, and it's exciting, and it just also brings me back to my roots and makes me know what I'm thankful for. Guys, today we have a case study. Okay, we're gonna go. I'm gonna read the news for you. We got to read the news. This is a big week for earnings, but I could not let something go. And this is without a doubt my biggest fault. Brandon will tell you this too. I have a hard time letting things go. So today we have a case study. One of my good friends, his name is Deshaun. He's a firefighter, and he has a 457, which is effectively, for everyone else out there, it's a 401k. And there's an advisor that's supposed to work it, okay? And we're going to go over the correspondence between this advisor and Deshaun, because Deshaun and I have talked, and I've said, hey, you need to make some changes. This is not good enough for where you're at. This is not what you should be in based upon your situation. And sincerely, I could not let go of how bad this advice and communication was from this advisor. So, and I'm going to call him a planner because he is a CFP, and it's a very difficult designation to get. However, they're not really advisors. They're just not. And you'll see what I mean when I go into detail. Okay, this is for anybody who has a employer-sponsored retirement plan. Please, and you have more than 10 years, okay? And honestly, could be 5, but 10 is a safe bet to cover my hiney if the SEC comes after me. But you do not need to be in a diversified 20, 30, 50 portfolio between international stocks, U.S. stocks, and bonds. That is a fallacy, and it's a buzzword that planners like to use because that was their education, okay? But if you want to look at the best investors in the world, they're not in international stocks and U.S. stocks and bonds, okay? Especially if you have a long time horizon. And I'll go into detail of why diversification, the way that they're explaining it, is not good. Okay? It's not good. And what I mean by not good is you're going to earn less. You're going to make a lower rate of return on your portfolio. And I'm already getting into it. So let me just read this. Let me read the news because the market opens in 10 minutes. And I was trying to get this out before 6:30. I just don't think it's going to happen today. So I'm sorry, guys. Okay. U.S. stock futures wobbled on Tuesday as investors considered the latest developments on President Trump's tariffs, including a potential auto sector reprieve and a concrete step towards new semiconductor and pharmaceutical duties. Futures attached to the Dow Jones Industrial Average moved down 0.3%, while those on the benchmark for the S&P lost 0.2%, and futures for the NASDAQ were flat. On Monday, U.S. stocks rose on the heels of a remarkably volatile week for markets following news that Trump's administration would treat tariffs on key electronics separately from duties on specific countries and would impose them at a later date. The president also floated possible tariff exemptions for car companies, sending auto stocks soaring. But any clarity emerging on Trump's trades continue to remain elusive as the president simultaneously pushed forward with plans to place tariffs on pharmaceuticals and semiconductor imports. On Tuesday, in addition to staying vigilant in the trade, investors will be watching corporate earnings. Bank of America, J&J, PNC are all set to report their earnings before the bell. Boeing stock fell more than 4% in pre-market trading Tuesday after Bloomberg News reported that China instructed its airlines to suspend additional trading jet deliveries. Dang. That's not good for Boeing. Boeing's just had a really bad a really bad last 18 months, I think. Traders will remain vigilant for any early signs on how tariff turmoil might affect companies' bottom lines, as well as what, if any, guidance they can provide for future quarters. Okay, so a couple of things that I did want to just touch on because we love making claims and owning claims, okay? If you guys listen to the last 10 podcasts, I can't remember which one it was, I talk specifically about, maybe it's the last five of mine, about making claims, okay? You want someone who is saying, hey, the evidence says this, and this is what I think is going to happen. A lot of advisors, planners do not do that. They refuse to do that. They'd rather keep it ambiguous, and I can't stand it because it just means that they don't have an opinion on stuff. But yet they're supposed to be professionals, and that bothers the crap out of me. Now, look, you can say, I don't know what's going to happen. We don't know how the market's going to react. And that's true. That's factual, okay? And we're living in that right now. I will say that, again, Tom Lee was correct, even though he was wrong a couple times in the last couple of months. And tariffs, like we had talked about, look to be the negotiating piece that America needed, okay? I can't stress that enough, that I think this entire time Trump was never planning on tariffing anybody. He was planning on threatening it. And maybe what I mean by that is he was betting, it was a huge bluff, that because these tariffs were just so egregious, and that's really what sent the stock market plummeting, was the fact that these tariffs were worse than he said, they were heavier than he said, and he was enacting them quicker than he said. It was like starting a fight in the cafeteria with every single kid. Okay, even if you're the biggest kid in the cafeteria, you're not winning that fight, right? So that caused a bunch of fear. It caused me to say, look, it's moments like this where I'm wrong, and I have to admit that I'm wrong. And for that moment, I was wrong. Okay, and this is the beautiful, beautiful thing about stocks or economies, is that really only time will tell. Okay, only time will tell. And we've now seen that just by the mere inkling of a article title or whispers from a spokesperson for a country, just the faint inkling of data that there might be deals that these countries want to do. Not even anything, they haven't even had meetings yet, some of them, with the president. And the stock market soars, okay? It's literally just whispers in the wind that can send this stock market right back to where it was, on better grounding, with better materials, and a better foundation. When that happens, guys, I'm telling you, and my money's all in the market, okay? My own money. The stock market will climb to new highs, and it will happen quickly, and it'll be frightening. It'll be frightening how quickly it happens. In a good way, obviously. Like you want to be a part of that. But the whole tariffs are wrong, tariffs are going to destroy the country. That is maybe true if they actually happen at the level at which Trump threatened them. But I think now, hindsight's 2020. You're looking back at how he made these threats, or these tariff threats. I just don't think that he actually ever meant them. It was meant to see, and this is the art of the deal, okay? And I wanted to talk more about this today, but we have to talk about the case study, so I'm going to be brief with this. The art of the deal is, you have the heaviest punch in the cafeteria. You do. And so you're basically baiting anybody in there, because they've been ripping you off, right? They've been giving you less food than everybody else, right? I don't know how you would steal it, or how you would ring it up here, but basically you call everybody out, and you want to see who's on your side. And that's what Trump was doing. And effectively 98% of everybody in the cafeteria was like, all right, hey, look, we don't want to fight with you. Okay, we do not want to fight with you. We'll come to the table. We'll make deals. We'll make this good for everybody at the table. And then there's China. Okay, and China said, no, screw you. We'll fight you right now. We'll fight you, like basically just saying we'll fight to the death, right? They use the words, we're not going to blink first. So what Trump did was, and this is so beautiful, the art of the deal. He took all of the pain and tariff punishment weight he was going to give to the other 98% of the countries. And he said, okay, you know what, China? We're going to remove all of their tariffs and we're just going to increase yours. And then China doubled down again and say, fine, we'll raise it by the same amount you're raising it. And then Trump put it in, it's like at 140% right now. I think effectively it's 125, but considering everything, 140 is an appropriate measure. That is, he turned the tide of a war, a tariff war, against the whole world against China. And let me explain what I mean by that. China is not a consumer nation. Okay, they expedite things. They aren't really big on consumption of other people's goods. So in the global trade market, their dollar isn't really that important. Now, it's their workforce that's extremely valuable. But what countries have realized, and you probably have shopped at these places, Alibaba, Temu, some of the other ones I can't even think of because they're all just so terrible. When another country goes there, they're notorious, and this is why tariffs aren't alone. Tariffs alone aren't a real reciprocal, meaning it's not an equal punishment for China because they do IP theft. So they steal intellectual property. So let me give you an example. So Amazon uses China, and this didn't exactly happen, but this is just my example. They go over to China. China sees how this business model works, and then they go and they create Temu, right? Or they create Alibaba, and they just make knockoff versions of what Amazon is doing. They basically make a cheaper, dirtier, quicker version of it. It's the same thing with DeepSeek that we're talking about. We talked about a couple weeks ago. It's the exact same thing. And what countries are realizing now is that if you go to China, they're going to steal your intellectual property and they're going to copy it and make something worse, cheaper, and undercut you. That's exactly what they're going to do. So Trump basically gave everybody a free invitation. Hey, that doesn't happen here in America, at least not on a country level. I'm sure individuals could try to do something like that, but it's not the United States government stealing IP. So they're essentially like, yeah, they do that, don't they? Well, we don't want to work there, or we don't want to take our factories there, our businesses there. Trump took China completely out of the game in the tradosphere, if you want to call it that. And guess where they're going to go if they're not going to China? They're going to go to the U.S., most likely. Okay, and if they don't go to the U.S., at least they're going to go to U.S. trade partners. Okay, so now the U.S. can say, hey, look what we did for you. We got rid of the big bad guy on the other end of the earth. How about you guys do something for us, right? It's all negotiating tactics. This is going to send the stock market to absolutely absurd levels. And I don't know when it's going to happen. I think it's definitely going to happen before his term is over. I was mad at him, and I still am a little mad at him. He basically did that trick where, like, you think you treat your girlfriend really, really poorly, all to lead up to this beautiful proposal, and like you mess with her mind a little bit. Trump did that, right? And then now that the proposal happened, you're kind of like, okay, wow, like this was really magical, and like I'm actually very impressed, and this is what we hired him for. Okay, the businessman. He is one of the best businessmen ever. You don't have to like him. I don't like the things he says. I don't like his mannerisms whenever he responds to people. It is so hard to look at. It elicits anger deep inside of my being when I see him respond with his facial expressions and mannerisms and whatnot. But man, is he good at the art of the deal. And this is going to change things for your grandkids. And if you're a millennial, it'll definitely happen in your life. But for the baby boomers, it really is a tough situation and a tough sell. I actually feel bad for them. And it kind of goes into what we're talking about with this case study. But the reason the baby boomers are going to suffer a little bit is because if you had any money in the market and you're taking money out now, boy, that's you might have lost a pretty penny. But the cool thing is we are not in a recessionary period anymore. Okay, the market did dip down between I think I think I said it was 4,927, and I think it went just below that, like in the late 480s. But it was quick, right? It was a quick and a quick moment down there at that bottom, and then we heard the whisperings, right? And it shot up. It had the second best day in the history of the stock market, which is pretty ridiculous. There were, well, probably in the last 50 years, there were a couple days during the Great Depression where I couldn't even tell you how high it was. But with their data collection back then, it's hard to really verify anything. But they definitely had some 10 to 15% days back then. Okay, so tariff talk. Just a little bit. I'll close out on this. Tariffs being used the way they're being used, absolutely amazing, very successful, very high likelihood of success to come out of this for American equities, okay, American companies, and the American consumer. If things turn awry, okay, I do not see it being the greatest scenario for Donald Trump, meaning he's going to have to take back his extremely confident statements. And we've seen him do it. We've seen him do it before. Even the fact that he's like, hey, I'm going to put a 90-day pause on all this. That was all part of the plan to see how countries would react, to see who would come to the side of the table that's on our side. Okay. And I could talk about tariff history. All that stuff's very boring. All you need to know is if you're not buying the S&P 500 right now, and you have 10, 15 years, or 5, 2, 3 kind of, it's hard for me to say because I can't give specific advice. I have to be very general in this. I will tell you that I think people will regret that. In general, the market is probably going to have pretty good returns. You don't even have to take risks in individual companies. Okay. Now, look, I'm at 17 minutes, but we have to talk about this case study. We have to do it. I'm unable to function. And I got Deshaun's permission to talk about this. So there is that SEC. Don't you come after me. Well, I was going to rhyme after that. That sounded like I was starting to rhyme, didn't it? Okay, so Deshaun. Deshaun is a fireman. And cities, municipalities, pretty much anything like any municipality, government entity, that they have a different retirement plan. Okay, they have what's called a 403B or a 457 or a 401A. They have pensions. They have a whole bunch of stuff that is very unique to that atmosphere. Now, there are entire companies that just work those accounts. Okay, so there is a financial planner, and we'll just call him Planner. He runs multiple cities. Okay. Not multiple cities. He runs probably like the police department, the fire department, the city postal, I don't even know, whatever, city workers essentially. And he's a CFP, which is a very difficult designation to achieve. So there's nothing wrong with that. I have very strong feelings because I started my career with financial planners, with them. Okay, I was under one. That was like the ultimate designation. You got to get the financial planning degree or designation. And what I learned was that ultimately that is a very prestigious 3 letters to have after your name. However, the value that you provide people isn't actually in what makes them money. Really, ultimately, at the very end of the day, their average rate of return is going to be what matters to people at the end of the day. Okay? It's just how it is. If someone averages 12% every year for 40 years, that's way better than averaging 9% and having a financial planner. There is no problem that 3% annually couldn't solve, that the financial planner is needed for. Meaning, if you hired a financial planner and you had like, hey, I want to make sure I leave my kids $150,000 each. I've got $1 million. Like, how do I live my life the best way I can? that question isn't even in existence if you got 12% for 40 years versus 9%. It's not even a question. You have probably 3 times as much money. Now, I will say there are very specific situations and scenarios, right? Like say you have a special needs child and you're a widow and you don't work, and like those kind of scenarios, sure, absolutely a financial planner makes a lot of sense. And one day I'm going to hire a financial planner for our firm because I like being able to provide that specific level of care. But this designation and this value is presented that it's great for everybody. When in reality, it's just not the truth. In fact, I'm giving this case study is an example of how it actually hurts people. So hurts people like you guys working in this industry. And it's not because he's a CFP that he is being bad, that he is what I would say is damaging the client. It's that's all he knows. He doesn't have he thinks he's doing the very best by the client. And he's just not. And I'll explain it. Mainly my issue was how he communicated with Deshaun. So let me go to my messages here. I just want to read this letter that, so Deshaun and I spoke. He's been getting, 2%. Okay. He's been getting 2% in his 457. Absolutely disgraceful, disgusting. If I was the manager in that account and I saw 2.5% for a 40-year-old, I would lose my freaking mind. And I'll explain why. For most of you, you probably know why. The market does 10%. The S&P 500 does 10% on average every year. That's the 500 largest companies in America. You're not taking any risk. Now, a financial planner would tell you, well, you're taking all the risk. You're only in stocks. That doesn't even make sense. Okay? If the easiest, cheapest thing to do, which is the VOO, okay, the S&P 500, you get 10%, is also the strongest economy in the world, the largest companies in the world, backed by the largest consumer nation in the world. That to me screams safety and it screams consistency. A lot of these bonds, so he likes bonds, right? Anybody who, when you hear the word diversity, it means that you have multiple investments that do not act the same. Okay, if stocks go up, bonds tend to go down. If stocks go up, international stocks tend to go at like an angle. Okay, so it's not, they don't work together. And then what happens is you get this middle of the pack rate of return, right? That doesn't sound good. That doesn't make any sense. The reason that they suggest that diversity word, diversify, is because it actually saves their butt. Okay, there's 2 reasons for that. One, when your account loses less, meaning you don't take the downturns as heavy, it's a lot better than if your account made more. So this is all very psychological here, so stay with me. When you lose less, your brain is able to say, oh, thank God. Like it's a protection mode, right? That feeling is way stronger than, oh, the market did 12 and we did 20? Oh, that's awesome. It's a quick set it, forget it kind of thing. So what they're able to do is protect their management style by diversifying people out of risk. And risk is very relative to the situation, but this guy was using the stock market as risk. And he actually called it chasing returns. Excuse me. Which is unbelievable. But this idea of diversification is not appropriate for people who are working and have at least a decade left. Maybe you could say, you could make an argument for somebody with 5 years left, right? When our clients start taking money out, they're immediately not invested in the stock market like they would have been 5-10 years ago while they were working, okay? So diversification makes a lot of sense to protect what you've already made. But if you have many years left to invest, every market downturn is an opportunity to buy things at a discount. And it's a hard concept for a lot of people to visualize, but you don't want things just to keep going up if you're investing and you have a decade left. You want things to be cheap. So when market downturns happen, you should be excited and say, I'm definitely going to buy the stock market. I'm absolutely going to do that. That's not how diversification works. Okay. This gentleman, Deshaun, is 40 years old, 41 years old. He's got 10, 15, 20 years left to work. So diversification doesn't make sense. Not only that, I got his rate of return. You know what it was last year when the markets did 24%? When the markets did this irks me so bad. 24%, Deshaun got 2.25. Okay. 2.25. Nothing bothers me more than that. And currently, even with his diversified portfolio, he's down like 1% on the year. So it's not even doing what it said it's supposed to do. Okay, so let me read this. This is what Deshaun said. And this is his, I'm reading you correspondence, okay? So, sorry, I know I'm all over the place here. I told Deshaun, hey, let's just put you in the S&P 500. You don't need to be in this special managed account that planner gets paid on, okay? There's an additional fee to that planner to be in these managed accounts. And maybe not the planner, but the company that he works for. I'm sure this guy's on a paper-pushing salary. I'm sure it's right around $100,000. And he probably gets a bonus for everybody that gets into this managed account. Okay. So, I almost said the advisor's name. Dear blank, I hope this message finds you well. I would like to discuss my 457 investment options as I have recently retained a financial advisor who will be assisting me in this process. If possible, I would appreciate the opportunity to go over these options with you. I'm hoping to schedule this discussion for Monday at around 3:30 p.m., which is when my financial advisor will be available. Please let me know if this time works for you or if there is any other times available that day. Thank you for your assistance, and I look forward to your reply. Okay, that was Deshaun, right? Professional as heck. Yeah, it was great. This is the advisor's response. Hi, good to hear from you. Congrats on getting an advisor. I am wondering why I am a CFP, a certified financial planner. Have over 20 years of working with clients. I am not sure what another advisor can do for you that I can't, but you are making decisions for you and your family, so whatever you think is best for you is totally okay with me. I am not sure what and how I can assist here. You can share your statement or access online for him or her to view your account. I don't know what else I can do to help. I really don't need to talk to him because there is nothing to add. You are in managed diversified portfolio. That is based on your retirement goals. If he wants to make changes to your allocation, you can get out of your managed account, and he can do the changes online for you. If I was you, I may not go that route, but it is up to you. We allocate your assets on a quarterly basis, and you have exposure to all asset classes, including U.S. and international stocks. I hope that helps. Thanks again. Okay. So that, first off, terrible email. Run-on sentences, not professional. I'm not sure what I can add. I don't know why I need to talk to him. Just not accessible. His whole job is relationships, and he just was trying to not have one, which, again, doesn't even make sense. All those buzzwords in there, did you guys hear that? He's in a diversified you're in a diversified portfolio. We allocate quarterly. You have exposure to international and U.S. stocks. This fits your retirement goals. Those types of things. If I called Deshaun and I was like, well, did you talk to him about your retirement goals? What were your goals that you told him? He'd go, I didn't tell him anything. None of that happened. Okay. That is typical jargon from these kind of planners. Okay. And again, I think the CFP is a designation worth having. I think it's prestigious. It's very difficult to obtain. Okay. But they don't actually care about the rate of return. They do not care if you make money. All they care about is if you give them your money. Okay? Financial planners, this is how I'll explain it. They provide a service that is information for you to do something one time. It's effectively a cash for service, one-time service deal. But they get paid acting as an advisor. A lot of them do. Meaning, I am actively managing people's money, trying to invest it, make changes, etc. These people don't do that. Okay, it's set it and forget it on this guy's behalf. His job is saying, ooh, diversification. You have 20 years left, but you should definitely be only 40% in the stock market. That doesn't even make sense. That makes zero sense. He's taking rate of return away from Deshaun. Okay, and he's covering it up by saying, well, he's diversified and now he's protected. You're not protected. Okay, you're actually harming him in the long run. Okay, and I'm going to read some of these other, as you can tell, I'm getting very heated here. Hopefully I'm coming across and making sense, because I am very long form concerned about this, and I could talk about it for days, because this happens all the time. Okay, all the time. It happened when I first started my career too, with all the financial planners. They don't make any investment choices. They tell you how diversified you should be, which is almost always inappropriate for the client's situation. And then they get paid a percent. They get paid a whole percent to do almost nothing. Okay, and that bothers me immensely, because what they do is they provide that diversification assessment, and then they have other people managing the money, and then they get paid on the money. So the financial planner gets a fee, and the person actually investing the assets gets a fee. Okay, it's all just so many ways to cut into your money. Okay, so let's see. Then Deshaun said this. Okay. Hi, so-and-so. I hope this email finds you well. Thank you for your prompt response. Since you're the advisor on my account, we can skip the meeting for now. I'd like to make some adjustments on my allocations with the goals of enhancing my retirement prospects and aiming for stronger returns than I have experienced in the past. Excellent, excellent email. Please allocate all future contributions to the fund that most closely tracks the S&P 500. If it's more convenient, I'd be happy to connect sometime this week to go over how to make these changes online. Excellent. I mean, I couldn't have written that better myself. That was awesome. Now, this is what this guy says. Keep in mind, Deshaun is 41. He's got 20 years left. Hey, thank you. Returns in the past are not projected for the future. Diversified allocation in most scenarios would have a lower volatility and a higher risk-adjusted performance than any asset class alone, for example. Buzzword, buzzword, buzzword. Oh, this infuriates me. Sorry. Because he's taking money away from Deshaun. Okay, this year, international stocks have outperformed U.S. stocks by a healthy margin. If you look at S&P 500 performance and your portfolio performance this year, you will see what I am referring to. There is no guarantee that trend would continue, but with recent policy change and weakening dollar, it may be the case. Please ask your advisor to look at similar period from 2000 to 2010. Now, I'm just sharing my thoughts as an advisor who would have been working with clients for various turbulent periods for 20 years. Please confirm again, and I will cancel your managed account strategy and allocate to S&P 500 fund if that is what you are looking to do. Thank you as always. Okay. And, ridiculous. Deshaun said, good morning. I hope this email finds you in good spirit. So I'm going to go ahead and push forward with my request. I do appreciate your input you're giving me. Based off what my advisor has told me, I believe you should go. Oh, no, that was the wrong. Hold on. That was a joke email that Deshaun had sent me that he was going to say. Hilarious. I almost read that out loud. Essentially, he said, please go ahead and do it. Okay, and he said, this is what George said. Sounds good. I requested your account to be out of the managed account. I believe I should be able to move all assets to S&P 500 fund on Thursday. You can get back into the managed account after a year if you decide to do it. I will make a note in your file. It was discussed we discussed diversified allocation. U.S. stocks could underperform, and this could hurt your overall plan. Chasing performance in only one market is not the best idea in my humble experience. U.S. represents 60% of the world's stock market, so you are not having exposure to 40% of the world's markets. Good luck, and keep me posted if you need anything else. Okay, so tons and tons and tons of things that are correct that are not good, okay? And I can, excuse me, we're at 34 minutes, so I can't rant about this much longer. You do not need to be exposed to the international markets, okay? Why would you want to be in other markets that you have no idea anything about them? Okay, they're international, and they consume U.S. stuff. The U.S. is the biggest economy in the world by a large margin. There is nothing more sound. If the U.S. stock market goes down, everything else in the whole world is going to go down. Everything else is crashing. Okay. If that goes to zero, the rest of the world is going to zero. And I mean that. Okay. There is nothing that doesn't save. If the U.S. economy goes down, the world is going down with it. It's the heaviest weight in the bag. Okay. When the heaviest weight falls, the whole bag falls. This guy is talking about diversification like it's going to add more return to his portfolio. The things that he said in there to Deshaun were incorrect. Okay, they're very incorrect. The international stock market, international stocks have universally, let's look at what it is. Let me just look it up. International stock lifetime return. There you go. International versus USA stock returns. Why is this hard for me to find right now? Well, let me just read this then. U.S. stocks have outperformed the world. History shows that success. I'm gonna pause this and look for it real quick. Give me a second, guys. Okay, I found it. Thank you for being patient with me. I was not prepared for that data. Okay, this is just the last 50 years. Okay, the S&P 500 has returned 10.7%. The MSCI EAFE, which is developed international, Europe, Australia, Far East, 7.1%. Okay, that is 3.5% less. You can go right now, do a future. I'll do it with you. Jeez Louise, I'm freaking hyped up. Future value calculator. We'll do $10,000. No, number of periods. We'll do 50 because that's how many periods we were doing there. We will do 7.1. Okay, that's $308,000 if you put $10,000 into the international stocks. Okay. Now let's do 10.7. 1.6 million. 300,000 to 1.6 million. Okay, I just cannot stand this guy. This guy has no idea what he's talking about to actually make people money. Now, he is correct in the sense that, yeah, diversification does lower volatility. Okay, it also lowers return, which is way more important for people with a long time horizon, but volatility is hard for people to see. Okay, and we're experiencing that right now. The market's dropped 1,000 points. That's a lot. Okay, I had to do a lot of phone calls this last couple of weeks just to talk people through it. It is difficult. However, that is in life. For every risk you take, there's a reward. Okay, and or a consequence, I guess. And sometimes it's positive, sometimes it's negative. The S&P 500 is one of those risks that when it's down, let me put it this way, and I'll end on this because I know we've been doing it this way. Investing is not gambling. Okay, investing is not gambling. The stock market, as far as I'm concerned, the S&P 500, the 500 largest companies in America, that should be in a majority of people's portfolios, 80% of it. 80% of their portfolio should be in the S&P 500. Now, again, I can't give advice because everybody's situation is very generic and specific. Not generic. It is very specific. But people like Warren Buffett, Peter Lynch, Ray Dalio, you could even say George Soros, these extremely excellent investors were all aware that the S&P 500 for the regular hard-working person is the foundation of any great portfolio. Any great portfolio. If Deshaun was to keep getting 2.5%, okay, he would have a majority of his money would not come from rate of return. It would come from his contributions. And I have a really hard time with that because if you give this guy 20 years at 10%, which is what the S&P does, he's going to be way better off. Okay, a bull market lasts 5 years, and a bear market lasts just under 1 year. Okay, there has not been since the Great Depression a market recession downturn that has not recouped within 24 months. None. So this guy's talking about diversification. You're diversifying him out of gains, and I cannot stand that. I just can't let it go. I'm way over my time, guys. I'm so sorry, but I did want to talk about that. And if you are in a 401k or a 457 or a 403b or a defined benefit plan, a 401a, what other ones can I make up? Or a profit sharing plan, a SERP, a defined contribution plan, just any of these accounts, and you don't know if you're in the S&P 500 or you don't know if you're in a managed account, meaning you're paying a platform fee, you're paying an advisory fee, you're paying a fund fee. If you don't know these things, please go talk to an RIA. Go talk to a registered investment advisor. Shoot, call me. Okay, email me. I'll help you. We won't charge anything. Okay, just help us or help yourself. Help me help you. Okay, please. I cannot see people in these. That guy's emails, they had a lot of buzzwords, and anyone, okay, who's not in the industry would see that and go, yeah, he sounds like he knows what he's talking about. He doesn't know what he's talking about. He just said the S&P 500 is chasing performance, the most sound, consistent economic machine on earth is not chasing performance. Okay, now if we put all our money into Tesla and Palantir, I mean, now, hey, you definitely chase the performance, all right, but you also might kill it. You never know. Also, I wanted to end on this. Palantir just got more government contracts, so you guys know we love Palantir. Palantir's our baby here. That's the one for us. Okay. That's it. Deshaun, I know you're going to listen to this. I am so sorry that you've had to deal with that. And any of these firemen or any of your fireman buddies that you send this to, just let them know I'm happy to help them. And look, guys, your situation is unique. It's very particular to you. And for people who can't deal with volatility, they need to be in a diversified portfolio, no doubt. Just do it. But if you have an advisor, our job is to quell you against selling when things are down and buying when things are high. It's actually to do the opposite. Okay? Do the opposite of that. It's very hard to do with your own money. That's why almost nobody makes money in the stock market because of emotions. Okay? I'm one step removed away. Now, I care about clients' money. In fact, that's like a saying we have. Nobody cares about your money more than you. I'll earn the right to be second. But that's the value in it, is I'm going to talk you off the cliff. Because there are people right now who sold 500 points ago on the stock market. They sold at 4,900. I just can't lose any more money. Well, they didn't get back in. How would they know to get back in 3 days later? Okay, you can't play the game with your emotions, which is what that advisor was doing. He was saying it's diversification. Hey, you want to be exposed to 40% more of the global markets. Like, what are you talking about? No, I don't. I want to be in the best. First off, S&P 500 companies. That's diversified. I don't care what anybody says. That is diversification in the literal sense. Okay, guys, that is it. I am tired. I'm done. 43 minutes. I just ranted at you. I hope you guys learned something. Please share this with somebody if they're in that situation, or if you're not sure if you're in that situation. We'll literally just tell you what we would do if we were you. Okay? That's it. You don't have to hire us. We're part of doing this job. Part of this podcast is to help people. And the more and more I see people like Deshaun, the more fired up I get that there's just bad advice. Okay. All right, guys. That is it. As always, invest early, invest often. We'll see you next week.